Hey guys, 2 minute warning. We'll kick off 2 minutes. Well, good morning, everybody, and welcome to the new season of the Daily Energy Markets Forum. I was going to have a new season, but then I just figured I'll send everybody ChatGPT and that'll be it. You won't need any podcasts. Omar said his spiel enough times that ChatGPT knows exactly what he's going to say, and we'll just bring that up. I suppose that's the crack. I wonder, does it know what the oil price is going to be for 2023? And if it does, perhaps we'll all become rich and famous. Oil prices did close 2022 on an average of almost $100 a barrel on Brent. And of course, we saw that grind lower in the final weeks of the year to be closer to $80, but ultimately the average of the year was 100. What will be the average for 2023? We had our kickoff forum crystal ball forum last week, and the sort of average analysis was lower, but not too much lower. Let's kick off this morning, the 16th of January, with Omar Najia, Global Head of Derivatives of BB Energy, and get Omar's sort of crystal ball outlook for the year ahead, as he was unable to join us last week. What are your thoughts, Omar, big picture themes for the year ahead?
Well, I think in terms of oil prices, if you look at WTI now, it's trading at about $79 plus or minus. If we can get over 81.50, then it would be basically short-term bullish. Maybe we have another pop to 100, but ultimately we're going to come back down again. So we are bearish, whether it's immediately from here. My money would say that we don't get over the 81.50 and we fall from here. That's one. I think basically there's a lot of people who are now bullish this market. The reason they are bullish is not exactly oil. It's more to do with equities. So equities, basically, again, I'm extremely bearish on equities unless they manage to close over the highs, the all-time highs we had in 2022. But there's a lot of people now who are saying, we've peaked in terms of interest rates, we've peaked in terms of inflation, and therefore, the US markets are going higher, blah, 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 which I don't buy at all. There's many reasons, and I could go into them. And then you have basically the US dollar and Bitcoin. So Bitcoin is looking hot to trot. It's trading at 21,000. If it breaks 21,500, then it goes higher. The reason we look at Bitcoin is because it's a risk-on indicator. So again, we even though it's very close, we'd say turns down from here, doesn't break 21,500. It's only $500-600 higher, but that's what I think. And that's it in a nutshell. So I think there's a lot of exuberance. There's a lot of new year, here we go, everything is okay, don't worry so much, why are you bearish, everything is rosy. And people like to say, China this, China that. which is quite interesting. Basically, that China is going to reopen, and somehow it's like a clicking thing. So they reopened today. So basically, that means magically, demand goes up massively or supply goes down or whatever the thinking that China is going to be doing X, Y, and Z. So all in all, we are negative unless we take out 8150 on WTI, unless we take out 21600 on Bitcoin, and unless we set new all-time highs on the S&P. So we wait and see. The last thing I'd say is the US dollar looks to have peaked, which means that basically the correction on the euro and the correction on the GBP that lasted all of 12 years, so almost 1.5 decades, that's finished, which means now that you're going to see dollar weakness, you're going to see the euro rally, you're going to see GBP rally, et cetera, et cetera. So it's going to be quite interesting because that never happens if you get a downturn in, let's say, a big recession, because people fly, there's a flight to a safe haven, which is the US dollar. So I think, things are changing, but let's see what happens. Very interesting market.
Osama Rizvi, energy and economic analyst at Primary Vision Network. Osama, welcome. All things in Pakistan are getting the headlines for what seems to be increasingly more and more duress. Your thoughts at this start of the year, the outlook for the year ahead, particularly for big emerging developing economies like Pakistan and Asia?
Yes, unfortunately, as Umar said, I do not see, I think Pakistan and other developing countries, I've been writing about it as well. This group of countries, we face a lot of challenges, although it looks like the dollar has peaked, but it still remains quite high. So the thing with these indicators is that recently the US inflation fell, but the point is it isn't increasing with the same amount of speed. That's the only thing. It is still very high. So for countries like Pakistan, for other countries like us, the global south, developing countries, emerging markets, so first of all, this strength of dollar, it remains a structural issue because our cost of debt servicing continues to increase. Then we have the food price inflation, and food prices in 2020 hit one of its highest level. We all know in Pakistan, if you specifically talk about Pakistan, we are the second most vulnerable country to rising food prices after Nigeria. And even IMF recently said that Pakistan faces heightened risk of labor activism and social unrests. And this has already started to happen. In my city of Lahore, we have protests every other day. It takes around 2 to 2.5 hours to get to somewhere, whereas in normal days, it would be just 30 minutes. So teachers are coming out, doctors are coming out, students are coming out for their fee and everything. And most importantly, in terms of oil prices, Pakistan's face one of the highest levels right now. And I'm expecting a mini budget as well before the actual budget. So the IMF deal is on. For Pakistan, we have entered New Year with a lot of unprecedented challenges. And I think this is 2023, whether people like it or not, they've already started to call me the doomsayer, but that is going to be the most difficult year ever in our country's history. I think we're reaching what can be termed as a tipping point.
You're going to need the Chinese coming over the hill to bail you out. Kate Durian, Mies contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. Kate, the year does start with a little bit, maybe it continues where it left off, but there does seem to be a schizophrenia in the noise, if you like. We started out the year with Brent, it's just below 80, and the IMF warning of a global recession in the major economies. And then at the same token, as Omar indicated, you have the financial markets, the equity markets in particular, soaring ahead on the premise that, well, the Fed's done, it's party time again, and China's reopening. Where do you fall in the outlook between those two forces?
I would never predict where oil prices are going to go. There's too many uncertainties. I mean, when we had our the event that you hosted about sort of looking ahead to 2023, I don't think you had two people saying exactly the same thing, what they expect. But I did say at the time that there's talking about the Middle East, for example, there's been a sort of dual track. There's dual track economies. The producing countries are sort of windfall revenues, whereas the other countries, the importing nations, the ones that are struggling, like Egypt, I said, are we looking at an Arab winter? And you see what's happening in Tunisia, where the Arab Spring all began. There's protests. The sort of the lesson that the democracy didn't really actually work. So I think we saw a sort of knee-jerk reaction by these countries because they have to maintain subsidies, they have to maintain, the social contract, while at the same time dealing with high inflation, with rising food prices, with shortages, with you've got issues, dollar shortages in Iraq, in Egypt. So I think it's very, very hard to say until you have a clear policy, government policies in these countries that will allow investors to come back in. I don't think you're going to see an inflow in investment, and that of course adds to social unrest. So I think and the oil producing countries that have raked in billions, when prices shot up last year to near records, are bailing out their sort of allies, but how much longer can that go on? So we don't know. The war is going on. Energy infrastructure in Ukraine is being destroyed. We're seeing more military support to Ukraine. So this war is going to drag on. It's not going to be over tomorrow. So I think it's very, very hard to say where it's going to go. The cap on Russian oil, the G7 cap, didn't actually come into effect until the 5th of December. So all these cargoes that you were seeing, we haven't seen the full impact yet. So how much Russian oil gets to the market, where it goes, at what price, is going to determine how we move forward. And also OPEC, they're meeting next month, so we'll see what they do, if prices stay where they are. The market is pretty flat if you look at the structure of the market. So I don't think anybody really can say with any certainty where prices are heading. If you look at the next 3 or 4 months, you don't have much of a
It does feel, Omar, that the as you mentioned in your opening comments, that the equity markets, the risk on markets, if you like, the risk markets, as you said, also with the crypto, they are moving. It seems quite aggressively on the idea, the simple sentiment that peak rates, peak inflation is in, and the physical oil markets seem to be still caught in the IMF headlines of possible global recession. China is reopening, but it's going to be a difficult reopening for a few months. So we're going to sit around $80, $85 of oil on Brent. These two things, which do you think of these two sentiments wins out in that possible challenge? You said taking out 81. Could the equity markets, the risk on, be the dominant sentiment?
Well, I mean, you have to understand. So basically, I think it is all about sentiment. So markets, they don't think, and they definitely don't count things, and they definitely don't look at supply, demand, and what China's going to do, next week. And, people are either bullish or bear. It's sentiment. So bottom line is, if you look at the S&P, right, people think that, peak, whatever it is, interest rates, peak inflation, so it's a good time to buy. The opposite says, for example, I mean, if you really think about it, so US treasuries are supposed to be quote unquote risk-free, right? Because the US government will always pay you back, because they can always print money and pay you back. So you have no risk of default. US treasuries for 2 years are plus or minus 5%. So you get paid 5% to buy US treasuries for 2 years. That's risk-free. If you wanted to buy, let's call it, I don't know, Amazon, they would need to perform better than that for you to put your money there. Because yes, Amazon can go up and Amazon could go down, and a lot of things can happen. It's not risk-free. So to put money in equities, you take a risk. So the return that you demand must be higher than 5%. And it's at least 10%. It's at least twice what so if I come to you and say, Sean, invest money with me risk-free, and you get 5%, how much would you, what would you demand if I could tell you, look, put some money with me and you might not get it back, or you might get some of it back? So usually, historically, that's been like 10 or 15%. That's not going to happen this year under any circumstance. So I like the fact. So we are very bearish, but I like the fact that people the market is trading in the mentality that everything's going to be okay. Peak this, peak that, because you need to have this rug pull that happens. And if you get this rug pull that happens, I don't know if it's going to happen this week, if it's going to happen next month. I have no idea. But I like the kind of way that the market's being complacent, that the market's thinking, let's maybe, put your toe in, let's see what happens, blah, blah, blah. So I like that. The only way that I'd be convinced that, to join that is if the S&P goes over the all-time highs. On oil, it's slightly different. On oil, above 81.50, I think we can shoot up to, let's call it 100, maybe a little bit higher. But after that, the trajectory for oil is lower, not higher. Let's wait and see. So I like this ebullience. I like this frothiness. Let's see what happens.
Osama, in the context of the point made about the duress of Pakistan and other even with whether peak inflation is behind us or not, or peak dollar is behind us or not, we're still in the wake of the consequence of that, and the challenge to emerging economies in Asia. Sri Lanka is still on the sort of death's doorstep, if you like. Where does China play a role for countries like Pakistan, Sri Lanka, and others in a state of duress in 2023? Maybe in the past you look to the IMF, you look to America, to come even to Saudi Arabia. But will there be an expectation? Will there be a turn to China for these moments of duress that weaker countries in Asia are now facing?
So international relations are a very interesting thing. Although China is our friend and our, sweeter than honey, tallest than the tallest of highest of the mountains and everything, but still no country would give us money. They have pledged a lot of money. They said, look, when you will need it, we're certainly going to cover you, but only when IMF endorses you. So, speaking about the influence in terms of international financial institutions, I believe, and whether we like it or not, that IMF still carries the torch. So until or unless IMF is going to help us, until unless it is going to clear the remaining amount of money, IMF is going to be satisfied by the measures Pakistan going to take in order to assure, that things would be better, deficit would be curtailed. No country is going to help us. There are about $15 billion something being pledged by different countries. China, Saudi Arabia, Qatar, but none of them have come in, and none of them will come in until unless IMF there. So I think this is the same with other countries. China is trying to be, very diplomatic. So we see that Iranian imports to China, exports to China have risen, and Russian have fallen after the price cap was introduced. So China is trying to, I think, play it very safe and try not to become, subjected to any sort of international or legal sort of issues. And that is the same thing when it comes to Pakistan. I unfortunately, people talk here a lot about this, that China should help us and everything, but I don't think they really understand how things work at the international front. So IMF it is. IMF is our savior. China is our friend.
Kate, on that point, you mentioned in your sort of ends point that OPEC Plus will be watching, will be looking. I mean, one of the things OPEC Plus perhaps need to absorb this year is the realization that China, while reopening, peak oil demand out of China could be close. It could be in the rearview mirror, even in the sense of getting back to 15.5 million barrels a day on China's oil consumption. Your thoughts on where China reopening as the sort of critical anchor for OPEC Plus in recent years, does that change or does that continue to be a symbiotic relationship?
I mean, I think it will be a symbiotic relationship because that is still the biggest market for Middle Eastern oil. And of course, now you've got competition from Russia using Chinese tankers to sell oil, below the market cap even. So you've got Iran selling to China as well. So they're going to have to be very competitive. But I think if you look at the growth expectations for economic growth in China, it's actually very weak. So even if you open, I mean, you might be seeing a surge at the moment because it's a Lunar New Year coming up. So you've got more travel, so products, transport fuels will spike. But I think, they still have this enormous COVID problem. They may have ended the restrictions, but you've got a lot of people falling sick, hospitals under pressure, the housing market still under pressure. So I think it's not going to help. Your industrial activity is not going to pick up that quickly, particularly in areas where you have, industry is concentrated. So I don't think you're going to have that much of a pull from China. Obviously, it's going to help, but it may be more that it depends. I mean, we'll just have to wait and see how much, whether they fill their strategic stocks. Whether they continue at these prices, probably not. So I don't think you're going to have much support from China. And Europe, you've had a relatively mild winter, so gas prices have come down, so you're not going to get that switch to oil. So I think you're going to see the first quarter, you're going to see more supply than demand.
Let's get the survey question in before we ask the panelists to tell us a little bit about what they think might be black swan events. The average price of Brent crude oil in 22 was just shy of $100 a barrel. What will it be in 2023? Closer to 70, 80, 90, 100, or 110? What is your sense of where things are going? Omar, speaking of sentiment and given where we've seen in recent years that the overarching sentiment of the markets have been delivered to a great extent by black swan events, COVID, the Russian invasion of Ukraine, and everything else sort of fall. Obviously, the inflation thing was also big, and there was other thing. But some of these big sort of cataclysmic moments in recent years have kind of dictated the direction of travel, and they've all happened in the first quarter. COVID was kind of a February, March thing. Russian invasion of Ukraine was February, March thing last year. So my question to you ultimately is, if you're looking in your crystal ball for kind of black swan moments, you mentioned one that I think is worth looking at. Not that you mentioned it, but you mentioned the fact that the US government is a guaranteed risk-free, they'll pay your money back. But perhaps one of the black swan events for 2023 will be the opposite, that the American government will default, and they're already arguing about their debt ceiling and the big war in the between that discussion. But your thoughts on what do you think could be a moment like that? Typically black swan, you don't see it, so I'm asking you to see something.
So I think basically usually what happens is when you get when the shit hits the wall, so to speak, people go to stuff that they know, and the biggest markets in the world, the currency markets, and they go to the US dollar, very simply, okay? Because everybody accepts it, it's recognized worldwide, blah, 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 right?
Liquidity,
and it's considered safe. In other words, you don't put your money in Zimbabwe, in the US, it's safe, blah, blah. So that's the first thing. Now, because the US dollar seems to have peaked, and I think, it looks very likely to have peaked, and have peaked, for something that's gone on for like at least 12 years, that turnaround, that start of the fall of the dollar, I think is going to be this, or might be this quote unquote black swan thing. So what would happen if the US equity markets and the markets in the West, the East a little bit less, start to implode, start to fall? S&P goes to 3,000, S&P goes to 2,500. What if that happens, and for the first time in history, people don't actually buy the US dollar, they actually buy something else, whether it be euros, GBPs, yen, rubles, yuan, whatever it is, because I think that something has fundamentally changed with that. So you have a lot of people sitting on massive deposits. The Chinese, if you look at the way that China's been dealing with its US holdings, its treasuries, it's been selling them non-stop. Russia's at zero. People are getting rid of their holdings of the US dollar because that's where most of the holdings are, the big majority of them, because of the US is perceived to be quote unquote unsafe. In other words, you might get sanctioned, they might take your money, et cetera, et cetera, et cetera. So I think the black swan would be the US dollar nosedives over time, equity markets nosedive over time, and there is no flight to safety. In other words, the safety won't be perceived as the US anymore. The rise of the petro yuan, and that kind of stuff, pricing of oil in gold, pricing of commodities in a basket of currencies. I think that's the kind of future you would look to. But I don't know if it's going to be Tuesday or next month at 3:50 in the afternoon, but I do know that it's coming, in my opinion.
Osama, your thoughts on that? I mean, we saw, black swan typically has a negative connotations to it. It's one of disruption and destruction. And we saw the COVID one being quite a bearish event, obviously dramatically so. The war in Ukraine ended up being a bullish one from the point of view of commodity markets. I suppose even the China decision to abandon zero COVID was quite a black swan event in the sense that it was completely unexpected that it would be so quick and so dramatic, with reports over the weekend of 60,000 deaths in the last few weeks. Your thoughts on that question and where you think it may come from?
I think, so I think one of the positive black swan events might be the cessation of hostilities between Russia and Ukraine. Might be. It's not typically a black swan, but that might. The second one,
unexpected. It certainly would be unexpected.
Yeah, and the second one would be the revival of the Iranian deal. I do not see that happening anytime soon, but that might be one of the things. In terms of the negative ones, if we want to go to extremes, we might see China and Taiwan engage in a little skirmish that may turn out to be another military intervention or something like that. That can be another effect. And in terms of emerging markets, talking about Pakistan or other countries, in extreme cases, you might see rearrangement of borders. You might see division in small administrative units. That is actually what the thoughts are right now here in Pakistan, if we don't do anything quickly. So the markets are aligned in such a way that there are variables that can go extremely positive and that can go extremely negative. So China's reopening, okay, that would be positive, but that's a double-edged sword. China's reopening will take up the values of commodities that might change Fed's pivot, and that might delay it further. Hence, we see that the inflation might have not peaked. So there are lots of a plethora of factors. But yeah, these are some of the ones that I can just come up, right now.
Kate, your thoughts? We got the survey result and give you the last word this morning on that. But the idea that there is closer to 90 Pippin, other ideas, we'll put that on social media today. Even the idea that perhaps the markets have kind of bought into this peak inflation has already occurred, and yet we got peak inflation last year, or at least high inflation last year when China was closed. It's hard to see that China won't have a big impact on inflation as it reopens on all engines going. But your thoughts, Kate, where you think the sentiment could come for the direction of the markets this year, and particularly the physical commodity markets?
Well, I mean, again, it depends on the war and its progress, because, obviously the whole food crisis is related to the war in Ukraine. But, being in the Middle East, I'm looking at Yemen, which is unresolved. There's no peace. I'm looking at Libya, which is unresolved. I'm looking at a very right-wing government in Israel, which could, I'm looking at Iran, protests continue in Iran. The nuclear deal is dead, and you've got a very,
they executed a former minister over the weekend, or at least in the last week.
Yeah,
in
so I
Iran.
mean, it's as and also there's, you know, we mustn't forget other potential flashpoints. You've got Taiwan, you know, that's one of the issues that may come up then. So and you see a hardening of the stance, you know, Washington, China, you know, the new law banning sales of SPR crude to China. So I think there's a lot of potential flashpoints, but there's also a sort of I think we're learning to live with this new reality, but at the same time, it's making it really, really difficult to come up with policies that are clear, that will actually allow this sort of the global economic engine to start moving forward. So I think that's where the biggest issue is. Obviously, a weaker dollar helps the importing countries, so it eases some pressure. But I think the potential for social unrest because of what's going on at the moment, and because of the pressures, the economic pressures on some of these developing countries, is actually very, very is a big risk to stability.
Well, certainly the rising interest rates. It does seem to me that the unspoken or not mentioned enough is the scale of the quantitative easing. Omar has referenced it before, in the sense that there is so much liquidity in the world today. The Fed balance sheet is at $8.5 trillion, which is tenfold what it was a decade ago. That continues to be the dominant force, to me, the dominant tsunami in so many ways, that liquidity is always looking for a return every day of the week, and ultimately risk assets will benefit from that, and inflation as well. And where that liquidity go, that sort of 3-4% interest rates doesn't seem to me to tame that tiger. That tiger will roar. It'll just find its outlet. Anyway, that's a wrap. Thank you so much. First episode of the new season. Kate Durian, thank you very much. Osama Rizvi and Omar Najia, have a great week. Great to see everybody. Happy New Year. And we'll catch up every day, 10:30 UAE time. All the best.
Thank you.